Have you ever looked at a truly legendary company and just wondered, what's their secret? What separates the good from the great, the flashes in the pan from the businesses that endure for decades? Well, in this explainer, we're going to unlock one of the most powerful concepts for understanding that long-term success, the economic moat. I mean, that's the million-dollar question, right? In business, success is like a beacon. It attracts competitors from all over. So when a company really strikes gold, what on earth stops a dozen rivals from swooping in and just, well, eating their lunch? The answer to that is exactly what we're here to talk about. And that answer is something called an economic moat. Seriously, think of it like an actual castle. A company's profits, that's the castle. And the economic moat is the big, wide, deep ditch around it that protects it from invaders, from the competition. It's that sustainable, structural advantage that keeps those competitors at bay, not just for a quarter, but year after year. So how do we spot one of these moats out in the wild? Well, that's the plan. We're going to walk through a really clear 4-step analysis to do just that. And you're definitely going to want to stick around to the end because we're going to wrap everything up with a super handy investor's checklist, and I've got a final question for you to chew on. Okay, so here's our game plan. Think of this as an investigation. First, we're going to hunt for the proof in the financial data. Then we'll play detective and identify the source of the company's power. After that, we'll figure out how to size up the moat. How strong is it really? And finally, we'll get to that actionable investor's checklist. Ready? Let's get started. All right, first things first. Before we can even begin to understand why a company has a moat, we need to find some cold, hard evidence that one even exists. And for that, we have to turn to the financial results. You know, the numbers don't lie. We're looking for companies that consistently earn profits way above what it costs them to operate. Our first piece of evidence? We're looking at free cash flow as a percentage of sales. Now, think of free cash flow as the pure, cold, hard cash a company has left over after paying for everything it needs to run and maintain the business. It's the fun money, the cash that can be used to buy other companies, pay dividends, or just build a fortress-like balance sheet. A company that consistently turns more than 5% of its sales into this kind of cash, well, it's not just profitable. It's a genuine cash machine. That's a huge tell. Next up, net margins. This metric is just beautiful in its simplicity. For every single dollar that comes in the door, how many cents does the company actually get to keep as pure profit? When you see a firm consistently posting net margins over 15%, it's telling you something really important. Either they have incredible pricing power, meaning you and I are willing to pay a premium for their stuff, or they have a ridiculously efficient operation that keeps their costs super low. Either way, it points to a moat. Our third indicator is a big one, return on equity, or ROE. This is the ultimate report card on management. It basically asks, how good is this team at turning the shareholders' own money into even more profit? It's all about how well they allocate capital. Any business that consistently cranks out an ROE above 15% isn't just running in place. It is actively compounding wealth for its owners. And let me tell you, that level of efficiency is almost impossible to keep up without some kind of protective moat. And our final clue from the financials is return on assets, or ROA. So while ROE looks at shareholder money, ROA looks at everything the company owns. Its factories, its technology, cash, inventory, the whole shebang. It asks how efficiently the company can squeeze profits out of its entire asset base. A consistent ROA over 7% suggests the company has a structural advantage. It just gets more bang for its buck than its rivals, and that is a classic sign of a moat. Okay. So here is the absolute crucial point. One great year, it doesn't prove a thing. A real economic moat reveals itself over time through consistency. You have to look at these numbers over a 5 or even better, a 10-year period. You've got to ask yourself, are these numbers consistently high? How do they look compared to their competitors, to the industry average? And what's the trend? Are they getting stronger or weaker? Consistency is what separates a one-hit wonder from a durable fortress. Okay, so we found the proof in the numbers. The company is a consistent profit machine. Now for the really fun part, the detective work. We have to figure out the source of that moat. We need to channel our inner 5-year-old and just keep asking one simple question. Why? Why can't competitors just come in and steal these amazing profits? Why?
As we do our detective work, what we find is that these powerful defenses almost always come from one of five main sources. There's having a truly different product or having a brand that people just love. There's being the absolute lowest cost producer. There are high switching costs that lock customers in. And finally, there are ways to just plain lock competitors out. So let's break each one of these down.
First up, differentiation. Now, a real differentiation comes from having better tech or better features. For a little while, a company might have the fastest chip or the coolest new gadget. But honestly, this kind of moat can be pretty shallow because rivals are always in a lab somewhere working day and night to copy and one-up you. But perceived differentiation? Oh, that's built on brand and reputation. This is when customers believe your product is better, often for deep emotional reasons. And that belief, man, that can be an incredibly durable defense. And this just illustrates the point perfectly. I mean, a diamond is a diamond, right? You can measure it, you can certify it, but a diamond from Tiffany presented in that iconic little blue box, it commands a way higher price. Why? Because that brand, that box, it actually increases a person's willingness to pay. That right there is the magic of a powerful brand. It's a moat built not out of bricks and mortar, but in the minds of customers. All right, the second source of a moat is simply being the low-cost producer. And you can get there in two main ways. First, a process advantage. This is about having a fundamentally smarter or more efficient way of doing things. Think about Dell's revolutionary build-to-order computer model back in the day. It completely slashed their inventory costs. The second way is a scale advantage. Think of a giant like Intel. They build these unbelievably massive factories that can pump out so many chips that the cost for each individual chip just plummets. Smaller rivals simply can't compete with that kind of scale. Now, this next one is subtle, but it is incredibly powerful. High switching costs. This is all about locking your customers in. And the cost to switch isn't always about money. A lot of the time it's about time and hassle and pain. Just think about it. Does a product require tons of training to use? Is it deeply embedded in a customer's business? You know, a surgeon who has spent years training on one company's artificial hip isn't just going to switch to a competitor's product to save a few bucks. The hassle and risk are way too high. That's a switching cost. So another way to build a moat is a regulatory lockout. This is when the government basically hands you a monopoly. The classic example is a pharmaceutical company like Pfizer with a patent on a blockbuster drug. For years, no one else is legally allowed to make it. And our fifth and final source, which might just be the most powerful of them all, is the network effect. This is that magic that happens when a service becomes more valuable the more people use it. Think about eBay. More sellers attract more buyers. More buyers attract even more sellers. It creates this powerful, unstoppable feedback loop that new competitors find almost impossible to break. Okay, so we found proof of a moat, and we've identified where it's coming from. But we are not done yet. For our final two steps, we need to size up that moat, we need to assess its durability, and then we need to take a hard look at the entire industry it operates in. So let's start with the moat's dimensions. Yeah, it's really crucial to think about a moat in two dimensions: its depth and its width. Depth is all about profitability. How much excess profit can the company generate right now? A tech company with a hot new patent might have an incredibly deep, but maybe temporary moat. Width, on the other hand, is all about durability. How long can the company defend those profits? Think of a brand like WD-40. It's not some high-growth rocket ship, but its moat is unbelievably wide. It has been defending its market for decades. The holy grail, of course, is finding a business with both a deep and a wide moat. But just knowing which dimension a company excels in is a huge piece of the analysis. And for our final step, we have to zoom out and analyze the industry itself. Because, you know, a strong castle in the middle of a war-torn land is still a really risky investment. You've got to ask, is this a growing industry or a shrinking one? Is profitability stable, or does it go up and down like a yo-yo? Is it a brutal, bloody price war between a ton of competitors, or is it a calm, rational market with just a few big players? The truth is, even the best company in the world is going to struggle if it's constantly fighting an uphill battle against the structure of its own industry. All right, we have covered a ton of ground here. We've gone from the nitty-gritty of the financial statements all the way up to the 30,000-foot view of the industry. So now, let's pull all of these clues together into that checklist I promised you. You know, this quote just nails the entire reason we're talking about this. The default setting in a competitive market is for huge profits to get competed away. It's like gravity. An economic moat is that rare, powerful force that actually defies that gravity, and it's what allows a great company to stay great. So here it is, your 4-step checklist for analyzing any company. Number 1, Find the proof in the numbers. Look for those consistent, high returns. 2. Identify the source. Is it the brand, low costs, switching costs, a network, or a patent? 3. Assess its dimensions. Is this moat deep? Is it wide, or is it both? And finally, number 4, analyze the entire industry landscape to understand the context. This right here is the framework for thinking clearly about a company's long-term competitive edge.
And that brings us to my final question for you. Now that you have this framework, I want you to look at the business world around you. Thinking about those 5 sources, which company today do you think is building the most durable defense for the future? And why? What's the source of its power? How wide do you think its moat really is? It's a really powerful exercise. Let us know what you think. Thanks for diving in with us.